Most traders don't realize how easy it is to dramatically improve the return potential of their options trades because they don't understand some pretty simple concepts that can be learned quickly. Hi, I'm Seth Freuberg, the head trader of S&B Capital's options trading desk here in Manhattan, and the guys on our trading desk understand how to structure their options income trades to maximize their return potential. In this video, we're going to be teaching you a simple technique for maximizing the risk-reward trade-off in options trades, so stick around. I'm positive you'll find this video very rewarding if you carefully focus on what we're about to teach you. Hi, I'm Seth Freuberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so over the past year, we partnered with a company known as InvestiQuant down in North Carolina to create a service we call the Weekly Options Income Machine, where we use a particular option strategy known as the credit spread to adopt a one-day directional signal that InvestiQuant developed through a massive amount of research and a great cost, which basically predicts whether the market is likely to rally off of its opening price, closing higher than the open, or conversely, whether it's likely to close lower than its opening print. And in working with InvestiQuant, we figured out how to substantially increase the win rate of their one-day signal through a particular use of the credit spread option strategy, which we explain to you in a minute. Now, before we get started with that, I wanted to make sure that everyone watching the video understands how index options work. If you already understand index options, this is going to be really quick, so just hang in there and we'll jump right back into the guts of the lesson. Okay, so think of an index option as a bet. What's known as a call option pays off if an index closes above what is known as the strike price of the option on the day that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 in cash per point that the market closes above that call's strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So, for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts, they would expire worthless because the market didn't close below the 4,000 strike price. Okay, so like we said, suppose that one day the InvestiQuant signal, which we call the IQ signal for short, suppose that the IQ signal suggested that the market is going to rally to close above its opening print, which is exactly what the signal indicated at the market open on March 5th. Well, last year we did an enormous amount of research to find the optimal way to take this information and turn it into an actionable options trade. And in this case, we would have adopted what is known as a put credit spread. So on March 5th, as we said, the signal indicated that the market's more likely to close higher than its opening print, which on that morning was 38.02. So that morning, we sent to our subscribers a notice that our system was suggesting a put credit spread trade where you'd sell the 3,800 put, which at the open was trading for 1956. Now, at that point, our subscribers have already been trained to determine the level of risk that they're willing to take on each trade, and as we'll explain shortly, in order to control the risk of each trade, you'd need at the same time that you sell that 3,800 put, to buy a long put farther away from the opening SPX price than the short put at 3,800. So for example, suppose that a trader decided to buy a long put at 37.80 at the same time. Well, at that point, the trader has now formed what is known as a put credit spread. Now, before we get into exactly how a put credit spread works and why buying that long put controls the risk of the trade, I wanted to let you know that if you want to learn the details of 3 additional option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so getting back to the put credit spread trade, let's break down what is going on here. So when the trader sells that put at 3,800, as we mentioned, he collected $19.56 for selling it, but each point represents $100 per point with index options, so you multiply that by 100 for a total cash inflow of $19.56. At the same time, you'd pay $12.43 for the put at 37.80, which, as you can see from the calculation, results in a payment of $12.43. And so the net positive cash flow from the trade is $713. Now, let's break down the risk of this trade. Let's say, for example, that that day the SPX closed at 37.80, which is exactly where the long put is. Well, on that day, the short put we sold would pay out $100 per point below 3,800, like we explained before, and it expired 20 points below 3,800 down at 37.80, so that would pay out $2,000, as you can see from the calculation. On the other hand, the market closed exactly where that 37.80 put is, so it pays out nothing because that put only pays out if the market closes below that price. And so the loss, considering the original cash flow, is $1,287. Now, let's say the market closes 25 points lower than that, this time at 37.55. Well, in that case, the 3,800 put pays out $4,500 because the market closed 45 points below that put. But this time, the 37.80 put pays us $2,500 because we're long that one and the market closed 25 points below that. So the net loss, again, is exactly what it was when the market closed 25 points higher at 37.80, namely $1,287. And so if you think about it logically, at any price below 37.80, the long put will reimburse us at exactly the same pace as the loss on the short strike is increasing, meaning that the loss can't get any worse than $1,287 no matter how low the market drops that day. So that is why we can say with confidence that the trade has a maximum loss of $1,287. And now you can see why we buy that long put, because it puts an absolute ceiling on the risk of the trade. Okay, now, so let's take a look at a second way the trader could have traded this, and that is selling 2 options at 3,800 and matching those 2 with 2 options at 37.90, 2 long options, this time 10 points apart. So let's take a look now at the cash flow of this trade. And as you can see, we were paid the same price for the 3,800 puts naturally, but this time we sold 2, resulting in $3,912 in positive cash flow, coupled with the outflow from buying those 2 37.90 puts of $3,128, resulting in a net cash inflow this time of $784, more than the $713 we got for the 120 wide trade we just showed you. But this time, the maximum loss and risk picture has changed. This time we receive $784 up front, and as you can see from the calculation, this time if the market closes at 37.90, where the long put is in this case, then you'd pay $100 per point for the 10 points by which the market invaded those short puts that we sold at 3,800, but this time we sold 2 of those. So we multiply that by 2 for a total loss of $2,000, the exact same loss as we discussed in the previous example of a 1-lot 20 wide put spread. And the 37.90 puts at that exact price both expire worthless for a resultant maximum loss, again, this time of $1,216. And again, why am I calling this the maximum loss? Because at any price below $37.90, the payoff we get from those two long puts at $37.90 will offset dollar for dollar the growth in how much we'd have to pay off under the two 3,800 puts at any price below $37.90. So we can confidently call that our maximum loss on the trade, just like we were able to do on the 20-wide trade. Now let's take a look at a third example, and that would be to sell 4 of the 5-wide put credit spreads, selling the 3,800 puts and buying the 3,795 puts. And as you can see, we receive about $7,800 for the 4 3,800 puts this time, much more than before because we're selling 4 of them. But we're turning around and shelling out $6,900 for the long puts, which are even more expensive per put because they're so close to the market's opening price. And so when you net that down, you receive $852 for entering this 4-lot 5-wide put credit spread. So now if we again turn to the risk side, we'll see that after you take into consideration the $852 we received initially for the 4-lot at a closing price of $37.95, this time we'll pay out $100 per point for the 5 points by which the market closed below our short puts, resulting again in a $2,000 payment and the $37.95 long puts expiring worthless. But for the same reasoning below, the bleeding stops below $37.95 because the long puts are growing as quickly in value as the short puts are hurting us, resulting in a maximum loss this time of $11.48. And so if you compare the risk-reward trade-offs, something emerges that you might not have expected. You see as you transition from the 1-lot 20-wide to the 4-lot 5-wide, your income increases on each trade and your risk gets smaller on each trade. And as you can see from this chart, the lowest return is the 1-lot 20-wide, which gives you a reward to risk of 54%, which results from the fact that it yields the least income, yet the most risk as well, because you're receiving less income up front for it. Whereas the 4-lot 5-wide trade gives you the most income and the least risk, resulting in incredible 74.2% reward potential. And the reason that this is true is that as the numerator, the premium received, increased in each case, the denominator decreased by even more in the return calculation, and as a result you get more reward and less risk simultaneously, which most people don't realize will happen when they trade spreads. In other words, in almost all cases, you're better off selling more spreads with a smaller width between the shorts and longs than you are selling less spreads with a greater width between the shorts and the longs. And the basic reason for this is that you're cutting the risk of the trade so much more than you're cutting down the income from each lot by paying more for the longs, that the result is a better return for the overall trade, even though you're shelling out way more dollars for the longs. The protections of those longs is so powerful that it increases the overall return of the trade substantially, as you can see. Incidentally, the SPX closed that day at 38.41 because the signal was right, as it is so often, and so because puts only have a value if the market closes below their strike prices, all of the options that we were just discussing expired worthless, as happens very frequently with the InvestiQuant signal because it's so powerful. And so the result is that the original credit that you received, you just get to pocket that at the end of the day because all of the options just died. So the only thing that's left is the cash flow, of which you get to keep all of. So what I'd like you to take away from today's video is that long options are used to protect short options when trading credit spreads, and usually the closer the long options are to the short options, the better the return potential of the trade, even though the long options will cost more because they're closer to the market. They cut down the risk of the trade so dramatically that it's worth it to pay more for the longs in almost all cases. Buying the closer options almost always improves the risk-reward trade-offs on credit spreads, and therefore should be looked at each time you sell a credit spread to maximize the return potential of your capital. Professional options traders know this principle very well, and now you have that knowledge as well. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it, and please don't forget to hit our subscribe button right now so that you don't miss any of our free training videos to help you to up your game as an options trader.